Okay, accounting scholars, we're going to talk about statement of cash flows. This is Professor Brown. Your motivation for today is there is nothing like you, there was nothing like you, and there shall be nothing like you. If you are willing to learn, no one can help you. If you're not willing to learn, no one can help you. If you are determined to learn, on the other hand, no one can stop you. So I hope most of you are on the no one can stop you from your goals. And if not, I need you to get to that point because that is the only way you're going to be able to succeed. Statement of cash flows. This is our overview. We learned statement of cash flows in chapter 1. So go back through the basic one before you jump into this extended one if you did not understand the basics. Chapter 1 will give you all the definitions of each part and help you to clearly understand this chapter. So we have 3 parts of cash: operating cash, investing cash, and financing. Operating is centered around your income statement. It is focused on the income statement, but it only cares about the cash transaction, which we know from our income statement, it includes cash and non-cash. So we're looking at revenues, but we only want revenues that were actually paid in cash, and we only want to deal with expenses or debt that we're paying that only deals with cash. So we have to true it down to that amount, which we'll talk about a little bit more as we go along. Investing cash has to do with your sale or purchase of fixed assets. Another name for fixed assets is long-term assets, or PPE, plant, property, or equipment. Investments is another form of cash flows in this area for investing. And investments means that the company themselves, the corporation, invests into another corporation or another business, which is very common. Your book does not go into that much detail, but it is something that you need to be aware of. Financing cash has to do with the last couple of chapters that we've been working with, where you learned about stocks and bonds. So we're going to receive cash from the sale of common stock and preferred stock, and even treasury stock if we have some that we sold, and issuance of bonds. Cash is going out for the payment of dividends to the stockholders, to buy back some of the treasury stock if we need to purchase some, and to redeem some of the bonds early, and or just to simply pay off the bond because it has matured. Some of the other things that the cash may go out for is the interest that we have to pay to the bondholder. So basically, the last 2 chapters increase the amount of items that are now listed under the financing cash. We're going to focus on the indirect method. The challenge in the indirect method is to narrow down your transactions to what were the cash transactions. The best way to do this is when you have the information, ask yourself, what was my original journal entry? What did I originally debit? What did I originally credit? That will tell you if the item is cash related or not. So we're going to start with net income. That's what we do when we use the indirect method. Remember, it is on the income statement. And here's a reminder of what's on the income statement. Revenues minus expenses equal net income or loss. This is what's taught in chapter 1. Chapter 5, we go over the multiple step income statement, which is NC Garner. Net sales minus cost of goods sold equals gross profit minus operating expenses, which is broken down into administrative and selling, which then gives you net income from operations, and then you subtract other expenses and other revenues to get net income. So either one of those, if you were stuck with either income statement, review those because you need to understand them for this part and for this last portion of the course. Remember, net income includes both cash and non-cash transactions, as we've been talking about. The goal is to exclude anything that was not cash related. We only want what was real cash, what's true cash. So we'll start after net income, we'll go to depreciation. If you remember the transaction for depreciation, that's a debit to depreciation expense and a credit to accumulated depreciation. Therefore, it is a non-cash transaction. Since it was a depreciation expense and we subtract expenses from revenues, we need to add it back. Then we would focus on gains and losses from sale of fixed assets, which we talked about in the fixed assets chapter. So if there is a gain, and gains and losses, remember, are reported on your income statement again. And so if there is a gain, we have to subtract it. If there is a loss, we have to add it. Typically, you don't have many losses, at least in this textbook. Okay, but you have an example of some, but you do have gains. And so you would subtract the gain because, again, These are non-cash transactions because this is based off of the book value, which is not a cash amount. Next, we will focus on the increases and decreases of current assets and liabilities. We're either going to add them or we're going to subtract them. Okay, a good rule of thumb is with your current assets, whatever it is, if it increase, you'll subtract. If it decrease, you'll add. You'll do the opposite math. If it is a liability, if it increases, you will add it. If it decreases, you will subtract it. So you would do the exact same math. So that's another way to remember that. Otherwise, you need to remember what's going on in that account. After you would have done all 4 of these items, then you would total up and get your operating cash. So it's a little bit more involved than what you did before. So make sure you go through either the author's video, read the textbook, and or practice as we go along. So let's walk through the process a little bit. So I created some steps for you to follow that are not necessarily indicated in your book verbatim, but these will help you to clarify all the data. So basically you have a word problem, you need to set up the word problem. How do you do that? Well, the first thing you need to do is label each account. They're going to give you a balance sheet, in other words, but each item on the balance sheet does not affect each section of the statement of cash flows, because remember, you have operating, you have investing, and you have financing, and certain items belong under each. So make sure you go back and understand the definitions of the items that belong so that you know what to pull out that is inclusive of operating, what to pull out that's inclusive of investing, and what is inclusive of financing. So you will label them. I would use O, I would use I, and I would use F. And remember, some of these items affect more than one. Well, what do I mean by that? Well, gain and losses of sale of fixed assets, for example, fixed assets only has to do with the investing section. But if it's a gain or a loss, the gain or the loss itself is affected in the operating section. And that's the only section that's reported on this statement. So next, what you would do after you label, that's step 1, O, I, or F, you would calculate increases or decreases. They're going to give you a balance sheet as of last year and this year. You want to know, did I increase in accounts receivables from last year to this year, or did I decrease? An increase, for example, in accounts receivable means that your customer charged more on account, which indicates it is not a cash activity. So therefore, you would need to remove it. On the other hand, if accounts receivable decrease, that is a cash activity because that means that your customer does not owe you as much. So therefore, you would include it. Now, going on to step 3, you're going to be given additional information. Now, you won't get this until you're given the whole statement of cash flows to do in your example. So that won't start until exercise 17, and then it will continue into the problem. But when you get the additional data, make sure you read all the information and set up your problem fully. So you've already labeled each item that they gave you, operating, investing, or financing. Then you subtract it to figure out if it was an increase or decrease. And you can use an arrow going up for increase, an arrow going down for decrease. And then you look at the additional data. The additional data is going to specifically tell you if, for example, you sold common stock for cash versus common stock as a non-cash transaction, which is, we know is possible, and we learned that in chapter 11. So you have to keep that in mind when they give you that detail. It's telling you what's included as cash and what is not. Another example would be when they tell you about dividends. They will tell you what was declared. Any dividends that were declared, are going to be paid. You learn that in chapter 11 as well. So it's certain words that are in your vocabulary that you should have in your notes that helps you understand what the word problem is trying to tell you. Okay, so read all the additional data and think about how it affects your information for operating cash, investing cash, and financing cash, and then use it where it's appropriate. So here we're going to start with the operating. Again, we begin with net income because we're going to adjust the net income. And remember, this information can be given to you from the retained earnings ledger. If you have income, it will be reported as a credit. If you have a loss, it will be reported as a debit. Next, you will look at depreciation. Then you will consider gains or losses on fixed assets. How do you determine that? Based off the book value of whatever the fixed asset is, in comparison to the amount that the item was sold for. So the difference between the two will tell you if it's a gain or if it's a loss. How you figure out the differences? Right over here when you figure out increases or decreases. You're only going to look at those amounts, increases and decreases, and use that to complete your statement of cash flows. Next, you have your current operating assets and liabilities, and the most common ones are accounts receivable, your inventory, your merchandise inventory, your accounts payable, and other accrued expenses, which we know accrued means that we are accumulating them, therefore we have not yet paid them. And then you will calculate the net cash flow for operating. Now here's an example of using the steps that I gave you. Okay, so first we have accounts receivable. Let me go back. I labeled them as O, all operating. None of these 5 items are related to investing or financing. These are all, and this is just this particular problem, these are all related to operating. So I labeled them all O. That was step 1. Step 2, I wanted to know, did I increase from 2016 to 2017, or did I decrease? Well, here in the first one, accounts receivable, I increased $9,000. So that means I have $9,000 more that the customer owes me. Not that the customer paid, but they owe me. So that is an increase to accounts receivable, which I need to adjust because it is not cash related. Then we have an $8,000, and the asterisk indicates a decrease for inventory, meaning that my total inventory, my total asset of inventory decreased. So I must have gotten rid of some. Then we have our accounts payable, which also decreased. So anytime your liabilities decrease, this means that cash was involved. So you have to make an adjustment for that. Accrued, all these have an adjustment, by the way. Accrued expenses payable, this one increased. That means that I owe more. Okay, so because I owe more, I did not actually pay any cash. And then we have income taxes payable, which here I owe less. So that means that I must have paid something. And then you have your total at the bottom, whatever that would be. The note that I have down here at the bottom is very important. Cash is given in the textbook problems to give you checkpoints. This is used at the end of the statement of cash flow. So if you remember, statement of cash flows is the only financial statement where the beginning balance is at the end of the whole statement. The cash account does not affect your operating section. So even though it's given in the operating section in most of your problems, it doesn't change anything. All it is your checkpoints. The former year, so if you were given cash for 2016, that will be your beginning balance. The latter year, 2017, will be your ending balance. This $9,000, if this were cash, would be the change in cash. That's what this is talking about, meaning that after you added operating, investing, and financing subtotals, your cash changed by that amount. Dividends payable is not listed here either because it does not affect the operating section. Dividends payable only affects the financing section, so therefore it would not have been listed here in my example because I'm just focused on operating. So here's your rule of thumb, and your book gives you this example. And this is only related to operating activity because, again, it is the one that has many steps in it. So you start with net income or loss, and then you adjust. You're starting with depreciation, you add it back. Why? Because depreciation was non-cash. If there's amortization, which we have not done any, but if there was some included, you would add it back as well because, again, it's non-cash. If it was a loss, you add it back because, again, it doesn't affect our cash, so we're adding it back. Then our gains, we do include it, but we have to subtract it, okay? Because we got a gain, meaning we received more, but we have to reduce it from our net income, okay? Then we have our changes in current operating assets and liabilities, and we have here an increase in non-cash current assets. So here we subtract it. So I just told you if it says increase with the asset, you subtract it, you do the opposite math. If it says decrease in asset, you add it. However, if it says increase in a liability, you add it because you're going to do the same math. If it says decrease in liability, you subtract it, same math. Then you add all those up and you're either going to have a positive cash flow or a negative cash flow, depending on if this is income or loss. Down at the bottom here, it gives you the rule of thumb of when to subtract and when to add. It tells you increases in accounts receivable, you're going to subtract. If it's a decrease, you will add, and so on and thus forth. So this is a good thing to use to follow, especially if the logic is not making sense to you right now. Some additional considerations for operating activities include the ones that are listed on the previous page, but I also included a couple others like decreases in accrued expense payable, increases in supplies, gain on sale of investment, amortization of your bond, depletion, amortization of patents, and these are some other things in the event that you had another problem that was larger and you needed to include this. Most of the problems that I've assigned to you does not include this, but this is a good rule of thumb to have. For just the operating section, because again, it is the longest part of the process, you need to practice, and that should be exercise EX 13-5 and 13-6. There is no template, so you do need to work it out on paper. It's important that you understand it. Now, investing and financing section. For the investing section, you're going to have cash received again from the sale of your investment or the sale of your fixed asset. Typically, we don't sell our fixed assets, but if you do, you'll have cash received from it. Cash will be paid out for buying fixed assets more than likely than selling them, and that includes plant, property, or equipment. And then you get a subtotal. Very straightforward and simple. Financing activities has to deal with common stock, preferred stock, or bonds, selling those, and then paying out dividends or purchasing or buying treasury stock back, and then redeeming bonds. It could also be a pure cash received for selling treasury stock, but again, your examples don't go that far. And then you will have a net cash flow from financing. Lastly, you will take all your totals and add them together. So you will have operating cash flows, investing, and financing. Add them all three together. This will determine whether your cash increased, your change in cash, or if it decreased. This should match the variance when you calculated the difference in cash that was given. Then you will add the beginning balance, and then your ending balance should be the cash that was given for the latter year. Remember, the beginning is the former year. To show you what I'm talking about, the example in your textbook started out with net income of 108. They added depreciation back in. They had a gain, so they reduced it. They had an increase in accounts receivable, which we just went over. That was subtracted. The decrease in inventory was added. The decrease in accounts payable was subtracted. The increase in accrued expenses was added. The decrease in income tax payable was subtracted. So the subtotal for operating cash was $100,500. Here in the investing cash, we had land that was sold. Okay, so we got cash for it of $72,000. Then we purchased some land for $15,000, and then we purchased a building for $60,000. So that net total is $75,000. So we add the two together for cash coming in. And this is duplicated for cash coming in. This is $3,000. And then our cash flows here from financing. We had cash from sale of common stock of $48,000. We had cash paid out for retiring our bonds. Retiring and redeeming mean the same thing. So anytime you see a word you're not sure what it means, look it up. So retiring and redemption are the same for the bond. So we pay $50,000 to get rid of the debt, and then we pay for cash dividends $24,000. The two of those add together gives us $74,000. So cash coming in was $48,000, cash going out was $74,000. So the net cash flow was $26,000. Then we add all three together. $100,500, $3,000 negative, and a negative $26,000. It shows that we have an increase in cash of $71,500. Okay, because if you notice, our positive cash up here is more than our negative cash. The beginning of the year balance was $26,000, and the end of the year balance was $97,500. So if you notice in the book when they did the subtraction between these two amounts, it equaled the $71,500, which is your change in cash. Disregard this bottom part. It is a duplicate of this top part, of the middle part. So again, I would go through, if I were you and I did not understand, go back through the indirect method as explained in your textbook, and then listen to this again and take the notes of the hints that I'm giving you. For practice, go to start with the basic exercises so you can understand it piece by piece. Do exercises 13, 1, 2, 3, 4, 5, and 6. It will walk you through each of the pieces for the indirect method. Then do exercise 2, 3, 2, 3, and 4. I already gave you 5 and 6 on the other slide, and then 17, and then PR 13-1A. If you're able to do these, then you're able to duplicate a statement of cash flows on your own. If you're not able to do 13-1A after you've done all of these, then you need to come see me or come see a tutor.